After the earthquake, the biggest impact by a mile has been Tokyo Bay, the area that was affected by liquefaction, the reclaimed land that was emerging as quite a strong new warehouse and office location. There, investors are now much, much more cautious. In general, however, central Tokyo, people still remaining quite optimistic about the outlook, particularly bearing in mind that the attitudes that occupiers are taking are going to encourage them to move into better quality office buildings in the centre of Tokyo, which will still have good quality power supply, are likely to have continued power supply. So that's going to play into the central Tokyo market, so in fact demand there picking up. But the notable feature has been the difference in attitude from international investors and domestic investors. Domestic investors, broadly, this hasn't really affected their view. Fundamentally, over the longer term, I don't think it's really affected the view of international investors either. But what we have seen is some of them saying, look, right now, until the ongoing nuclear situation is fully resolved, until we can see what's happening from a power supply point of view, it's just difficult to price the market. It's difficult to take all of my investors with me and convince them that buying in Japan is a good thing. So right now, Japan isn't a no, it's just probably not quite at the moment. But they'll be back. Japan's too big to ignore for most international investors.
What about capital diverting elsewhere and coming maybe even into Australia that would have otherwise gone to Japan?
An interesting point, yes. I mean, we have seen a couple of investors actually turn around and say, now we think that Japan is a buying opportunity. In general, as I say, that pause, there are quite a few people who we've seen who were expecting to get on a plane to Japan, have in fact said, no, we're now going to Australia. That Sydney is one of the markets, Sydney in particular, but Australia is a market that we think offers some pretty reasonable fundamentals and actually looks fairly attractive to us. So we have seen some diversion of demand down to this part of the world.
Okay, well that's probably a good point to in fact focus the balance of the presentation on Australia and Sydney. So thanks Nick.
No problem.
Well, I guess the context here in Australia and New South Wales is we assume one of gradually improving economic conditions. Obviously delayed from what we expected 12 months ago. We see, particularly in New South Wales, a very gradual recovery here. Obviously, state government doing all it can to stimulate economic activity. That's going to take, we think, a couple of terms before it really makes a difference. The high cost of debt that we think will be continuing in the short term really does hold New South Wales back more than other states, and given the high cost of housing here particularly. But as we move into the recovery, we do notice that vacancy rates are still generally low across office and industrial. So we see very clear and stronger outlook for office and industrial, while retail still obviously has some issues surrounding it. No, they aren't necessarily New South Wales focused, but much bigger than that too. We do think that the global exposure that Sydney has means that the impacts of uncertainty will hit this market more than elsewhere in Australia. And we've noticed that, I think, in the last year or two, where we have what we'd call a fitful recovery, where you have periods of strong confidence, where decisions are made for leasing, for investment, and then it drops away very quickly and takes some time to recover again. We think that sort of pattern will continue, especially given the sort of outlook that Nick talks about in Europe and the concerns over the debt markets. Excuse me. So where does Australia and New South Wales fit in an economic ranking sense? Well, if you look at this chart, it'll show you that New South Wales will have some measure of improvement over the next 12 months, but effectively, you know, New South Wales is still underperforming. It's still underperforming the rest of the country, and the forecasts call for that to continue. For an economy of this size, it really should be doing better. So its growth rates, ironically, are looking more like those of USA and UK over the next 12 months. Whereas Australia overall will start to pick up on the back of Queensland and WA starting to emerge more strongly over the next 12 months and start to sort of fall at the tail end of the rankings for those emerging economies that Nick talked about, especially in Asia. So one of the key drivers of commercial real estate, of course, is employment growth. And I think this is where we'll see that sort of divide between the stronger states of Australia and the ones that will continue to grow. And there's not as though to say there won't be growth in New South Wales, but it will be simply outgrown in the next year or two. And that divide will open up as we move into this effect of the resources sector starting to influence the overall economy more and employment growth in especially WA and Queensland. On the investment front, well, we've talked a lot about how there's certainly capital out there, and I think Sydney is a good example of a market where there's just not the supply of prime grade stock in the market, and as a result of that, we've seen investment activity reach quite a low point. And ironically, the share of investment activity around Australia now in New South Wales is less than the size of the share of the economy, which is around 35%. Yet only 25% of the investment activity is occurring here, and that's been falling for about 6 or 7 years now already. So there's not as though there's not the demand to get into Sydney, and we know that globally we're still seeing plenty of interest to get into this market, but the prime grade stock is just not coming onto the market. Well, who is doing the buying? Part of the reasons for the slowness in the investment market here, we think, is that two key reasons. One is that the big player in the investment markets here has traditionally been the REITs. And while the REITs have come back some over the last couple of years, they would have traditionally represented about maybe 50%, as much as 60% of all purchases in any given year. At the moment, that's still down around the 20% mark. So the other reason, of course, is the availability of debt, the cost and availability of that. And of course, those two things, REITs and debt, perhaps come together and work to keep the volume of trading activity below where it really should be. There's great... Sorry, Nick?
So what about international investment? Because we've talked about seeing some diversion from Japan, but
Yep.
Sydney has long been a favoured target. I see foreign investors quite low there in New South Wales. But are you seeing that coming through? The international interest and international capital coming through from Asia or elsewhere?
Well, absolutely. I mean, we're seeing interest every week. There's someone in the Sydney looking to buy and to look at properties. I mean, this chart shows you the actual cross-border, the share of cross-border investment activity globally has been tracking around about 20% of all global investment activity, while Australia's obviously a smaller market, tends to spike a little more, but it's been tracking above the global level. And we know so far this quarter is about 50% of all purchases, early as it is in the quarter, have been to foreign investors. And sure, the sources are spreading out from South Africa to Canada, to the US. So places we've never seen investment before starting to come into Sydney. So definitely that demand is there to come into this market. Yeah. So for Sydney CBD, let's focus a little bit more now on the outlook just for the Sydney CBD market. I guess the last few years we've been here talking about 2012 was a really important year for the Sydney CBD market. We've seen this sort of supply gap, mind the gap. 2012 we thought was a year when the amount of new space coming into the market and the occupational side will be hitting a low point. And it's very important because the demand for space is still increasing. Okay, it's a fitful recovery, it's very much up and down, but if you look over the longer term, the expansion in occupied space is continuing. And so you put those two together, you start to see vacancy falling, and we think by the end of this year prime vacancies will be as low as 6%. They're well on the way to do that now. And this time last year we said with the net absorption in the CBD would be about 100,000 square metres. Now that was a very optimistic call last year, but it turned out to be just about that, 100,000 square metres. We think it'll be about the same this year, and that will start to bring vacancy into that clear downward movement through the back half of this year and into 2012. So we think our forecasts have been broadly correct in moving into that period of 2012, where there'll be the right conditions to start to see rents moving up. And that's certainly what this chart shows you, that by 2012 we do expect to see face rents. We see the combined effect of face rents moving up. Our forecast is still pretty much in line with where it's been the last few years, that by next year we should see face rents moving up about 10 to 12%. Combined with, of course, the fact that incentives are already starting to move downward. And the two working together could be give quite a super boost to returns over the next 12 to 18 months. And we think it is actually starting to happen. The second quarter started to witness some movement in rentals from the top end, and then starting to move down the quality grades, and then ultimately that will spread out to the suburbs as well. So the forecast is unfolding. It's taking longer than we thought, a little bit longer. It's certainly been a difficult process, but it is getting there. So the income growth will be the key value driver in this recovery, and we don't see a lot of scope for cap rate compression to drive values. The long-term cost of debt and the spreads to that will be somewhat compromised, but we still think there's some scope for a small measure of compression.